Hey everyone, welcome back to Upside Down Data. In this video, I'm going to give you an update on the current state of the UDPI risk indicator for Bitcoin at both the long-term and medium and short-term timeframes. I'm also going to share with you a new stablecoin farm with a pretty nice yield to give you something new to look at and to potentially benefit from during this brutal bear market that we're experiencing right now. So if you guys like the content, subscribe to the channel, give the video a like, and follow us on Twitter at Upside Down Data. We put out regular updates there about our risk indicators, including for 24 altcoins that I'm not going to be covering in this video, and more. What you see up here on the screen, as I noted, is the UDPI, that's the upside downside potential indicator for Bitcoin across those three time frames. And so the long-term time frame is meant to be interpreted on a time frame of months. The medium term is meant to be interpreted on a time frame of weeks to months, and the short term on a time frame of days to weeks. And so these are complementary pieces of information, and together they can give us a pretty comprehensive sense of what the contemporary price action is doing relative to Bitcoin's historical price action. This is a young asset. You know, Bitcoin is the granddaddy of the crypto market, but it's still a young asset. We need to keep that in mind because the reality of the situation is that we're still in the early days and we just don't have a lot of data. And so, as we've noted in previous videos, and I think is becoming more and more clear as we watch this price action play out, we need to be prepared for the unprecedented. We need to expect the unprecedented. And so we're not going to be able to say anything definitive based on history. And yet, that's the most useful information that we have. And so to try to put what we're seeing right now into context is, I think, really valuable and really important to keep doing on a continual basis. What we have here is a pretty low long-term risk, below -3. Just over the last couple of days, the long-term UDPI risk, that's the upside downside potential for Bitcoin, has gotten even lower into ranges that historically have coincided with very good buying opportunities in the long term, not necessarily in the short term. When the UDPI has been down at this level, it could stay there. It's happened in the context of prolonged bear markets. It's also happened in the context of rapid capitulations that have reversed to the upside. And so both of those kinds of situations are possible from the UDPI's perspective. But what's certain from the perspective of history is that buying when risk is at this low level tends to work out in the long term, if not in the short term. The medium and short term are also grinding down to lower and lower levels of risk. And interestingly, the short term is approaching getting lower than the medium term. I'm going to pull up a chart in a moment that shows how the short and medium relate to each other because it's often been a signal of sorts when we see the short-term risk getting below the medium-term risk rather. But I'm getting a little bit ahead of myself with that because I want to first bring up the long-term chart. This is the output of the UDPI across time. So higher values here up on the top of the screen represent higher levels of risk. Lower values represent lower levels of risk. And we've now just passed -3 on the risk chart, which is something that has happened, as I mentioned, in kind of two types of situations. One of those types of situations has been in these prolonged bear periods. And when that happens, the UDPI tends to hang out under those levels for quite a while, typically treating -2 as a resistance and oscillating between that level and -4. That's what's characterized those prolonged bear market periods. On the other hand, we've also seen the UDPI get down to these lower levels during bottoms, some of those being kind of liquidation events, these rapid capitulations that get bought up very quickly, and others being more gradual. So at the end of 2018, when that bear market bottomed, so did the UDPI, went all the way down to -5, and that was kind of a gradual event. It spent some time down at those lower price levels before beginning its next macro bull market phase and shifting momentum from those lower levels. But on the other hand, in March 2020, when COVID first came along, there was a much more rapid drop down, and the UDPI also reacted with it in the middle of 2021 as well. when we saw the price drop during the middle and end of May, and then continue in a bear period until the end of July, about July 21st, UDPI also dropped down below -3. And so those are kind of the two types of behaviors that could play out here. I want to see over the coming weeks which one seems to be better supported. Are we going to kind of oscillate between -2 and -4 perhaps and see a prolonged period like that? Or are we going to see a more rapid reversal? Maybe not at the current level, which is about 35K, although that's of course possible, but maybe a bit lower. Maybe we'll go down to 30K, where there's a lot of support, where some really influential whales have their cost basis, for example. So MicroStrategy, run by Michael Saylor, has an average entry price of around 30K. And so that's a significant level for a lot of people. It's also a significant psychological level. I'm just speculating now, but that would be something that we would want to look for to determine whether this is going to be more rapid or more gradual. Right now, it's just too early to say what kind of price action we're setting up for. But we've entered this region here, and that's notable in and of itself. I also want to, as I mentioned, bring up the medium and short term in relation to each other. So I've overlaid the medium and short term UDPIs here. So the medium is in yellow. Remember, that's meant to be interpreted on a scale of weeks to months. And the short term is in red, and that's meant to be interpreted on a scale of days to weeks. And what I want to draw your attention to here is that when the short-term UDPI has become more extreme than the medium-term UDPI, that tends not to last very long. By more extreme, I mean when the risk is in the positive territory, meaning it's relatively high. We want to see that the short term is higher than the medium term. Or conversely, when the risk is relatively low overall and we're in the negative territory, this would represent the short term being lower risk than the medium term. And that tends not to last very long. And often it coincides with these very rapid movements. So the COVID crash down here on the downside, and in the middle of, in May 2021, in both of those cases, we saw the short-term UDPI risk get lower than the medium-term UDPI risk, which is an indication that the volatility to the downside has been quite extreme in the short term. On the other hand, to the top, we've seen this happen several times. We saw it happen in the first bull market in 2013. We saw it happen at the end of 2017, in December. We also saw it happen more recently, for example, the bull market at the beginning of 2021, and then the later moves up in the late summer, early fall, and then more recently later in the fall or early winter of 2021. In all of those cases, the volatility on the short term was such that the short-term UDPI became more extended than the medium-term UDPI. I think what that indicates is that in the short term, volatility cannot continue to be so extreme so continuously. It doesn't necessarily mean that a price reversal has to happen, but it does suggest that probably we're reaching a point, as we see here, they're now at a similar level. We might be approaching a point where the short-term volatility is getting a bit exhausted. Again, that does not mean that the price has to reverse, but it might mean that things are likely to start calming down a little bit. Now, the short-term UDPI risk is not yet lower than the medium-term UDPI risk, so we're not quite at that stage yet, like we've seen, again, back here in the middle of 2021, in March 2020. Also, in these instances before the major parabolic move in late 2017, we also saw that happen a few times. And so, historically, short-term getting lower than medium-term has been often followed by trend reversals, but it doesn't necessarily indicate that. It just means that we're getting to a point where the short-term volatility is really extreme. And so if this continues down, let's say we get another big move down this coming week, who knows if that will happen, but if that were to happen, then we would probably see the short-term UDPI continue down lower and outstrip the medium-term UDPI here. And that would indicate that, wow, things are really getting very extreme to the downside, and we would expect things probably to start calming down a little bit and to allow the risk to reset, possibly to instigate a trend reversal, possibly, but possibly also just to chill out for a little bit. So this is useful to watch because it tells you something about how extreme the short-term volatility is. So we'll be keeping an eye on this. One other thing I want to pivot here, shift gears, and tell you about a new opportunity that's come along, because you've got to make the bear market bearable, right? If all we're doing here is having exposure to risky assets that are going down very rapidly, well, that's not very much fun. But there are other things that we can do in this market to grow our stacks and to position ourselves for future opportunities. For example, let's say that there was a major liquidation event, so a very, very rapid fall like we saw in March 2020, sometime in the next couple of months. If that were to happen, it would be nice to have some cash on hand. And one way to prepare for that is to begin building a position of cash and to grow it a little bit. And there are some really good opportunities to earn interest on your stable coins, on your dollars, essentially, that are much, much better than anything you can get in traditional finance. And so here I'm pulling up StellaSwap, which is a new decentralized exchange on the Moonbeam network. Moonbeam is the first parachain to go live on Polkadot. And this is the first DEX to go live on Moonbeam. And what I want to show you here is that they have some very lucrative opportunities for providing liquidity on stablecoins. So right here we have 40% and 35% annualized returns for providing liquidity for DAI US dollar coin on one hand and US dollar coin and USDT on the other hand. So these are relatively low risk, right? I mean, if the risk here is that one of these stablecoins could lose their peg, meaning it could stop being valued at $1 temporarily, and that could cause impermanent loss. But that's pretty unlikely, although it is possible. And the other kind of risk is that you have to trust StellaSwap, that there isn't going to be some kind of exploit or some kind of bug. And so going all in on any one farm is not advisable. But there's no reason to be concerned about this particular platform, and beginning to build a position here is a way to get ready for a buying opportunity. You could also be, building your stack here and dollar cost averaging into the market at these low risk levels that I've mentioned. That tends to work out in the long term when risk is around these kinds of low levels. But I want to give you something to think about here and something to do that's beyond just waiting and kind of, trying to keep happy while we see the market grind downwards. So I hope you guys found this useful. Thanks for watching.